Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the definition of long-term asset charges. As we do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, and then we'll go on to look at an example and give you more insight. Deferred long-term asset charges are expenses, which is very important to remember, which the company has paid for but not yet subtracted from the assets. Deferred long-term asset charges are very similar to prepaid expenses. The difference is that when companies prepay an expense of some sort, they have a legal right to collect the service. Deferred long-term asset charges have no legal rights attached to them. Now let's look at an example. In many cases, when you're looking at a company's balance sheet, under the very bottom you can find, or near the bottom at least, you will find deferred long-term asset charges, and in many cases you won't find anything actually listed there. But in some cases you may, and when you're looking at that you want to know what's actually in there. You need to go actually look at the company's 10K or the annual report for the company and read the notes on that to see what exactly for that particular company they are calling deferred long-term asset charges, or what they have in that category. Let me give you an example. I'll give you two examples. So first I will talk about a prepaid expense, which this is much like, as the definition already said. The prepaid expense would be, let's say that a company says, you know what, we want to move all of our office furniture into long-term storage. So they would pay for this long-term storage up front, and that would go into a prepaid expense, or that may just get tossed into the other assets if they don't want to actually itemize it as a prepaid expense. And that would give you certain rights. You would know that, okay, well, we paid for 3 years of long-term storage, so we have the rights to that storage for the next 3 years. And they would simply expense that off, basically, or write that down over the next 3 years. Deferred long-term asset charge is a little bit different. It's an expense, however, there's no rights to it. So let's say the company says, okay, we're going to move all this furniture into long-term storage. We need to hire some guys to come out here and load this stuff up and move it for us. And so they do. Maybe the company has to pay, you know, $10,000 or whatever number for moving all this equipment, right? Well, they pay that amount. And then they say, you know what, we don't really want to write this off as an expense that, you know, hit us right now, so let's spread this out over the 3-year term that we have for this actual long-term storage. We'll just call it the deferred asset charges. That's what we'll do. So they go ahead and they write that into there, and then that's another way of basically taking an expense and spreading it out over the life of something. The only difference is it's a really, really weak asset, if it's an asset at all. It's just another way that management may try to boost their balance sheet and their assets into where anything here, in most cases, you're simply just going to strike it and ignore it. It's not really all that creditable, and it's just going to get decreased over time anyway. And now you know. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.